Welcome to the Full Stack Business Owner Podcast, where we are enhancing your full stack of skills to build wealth inside and outside your business. Today, we are with Goose McGrath, our property portfolio growth partners, and we're talking all things that full stack business owners talk about. Now, if you want to jump in on the conversation, head over to the Facebook group, join a full stack business owner community, ping Goose, ping Charlie, ping myself, ask any questions you've got, because this is an interesting and a polarizing episode. Now, before we get started, let's cue Charlie's infamous disclaimer.
Charlie here from Full Stack Business Owner. I need to let you know that Grant, myself, and the Full Stack Business Owner team are in no way, shape, or form qualified to give you financial advice or pick investment products. We highly encourage you seek out and engage the use of professionals when making financial decisions or comparing investment products. All right, I'm pretty excited for this one. So full disclosure, Goose and the Dashdot team are sponsors of Full Stack Business Owner. They are on board and been helping us in a big way. We just want to make sure you're aware that they are a sponsor, as we do need to disclose that. Now, Goose is a truly interesting human. I want to tell a little story before we get into this one. Many times in my wealth building journey, and I mean many times, I've done a ton of research, I've done courses, I've read books, and I've gone to Goose and go, what about this? And then within 30 seconds, he completely shatters my mind. He gives me this little different lens to look through, or a stat or a unique thinking that I wasn't doing because I was going with the masses, and it completely reshapes it. And I think I've probably wasted hours researching things that then tend to be not what actually happens. Now, on a personal front, by leaning into Goose's unique thinking, it's also been very advantageous for me personally. And Goose has been, I'll say, the architect behind a lot of the property stuff I've done, and actually helped me build my wealth in a big way because of this unique thinking. So Goose, I'll get you to do a 30-second intro. And then what we're going to do today is we're going to jump in and look at some of the things that are going on today.
Perfect. Awesome. So thanks for that beautiful introduction, Charlie. I really, really appreciate it. And I'm so grateful that I've been able to contribute to your journey. A little bit of a quick intro on myself. So a few years ago, I was broke, burnt out, going nowhere, running a business in a completely different industry. Thought, how am I going to change my life? Me and my partner Gabby thought, I know the solution. Let's invest in property because, hey, it just always goes up, etc. We successfully bought the wrong property, the wrong place at the wrong time, lost a bunch of money, and went, hang on a second, that's not how that was supposed to work. And then since then have been on a quest to try and work out how the game works. And that quest for the truth, the answer, is the thing that drives our business today. So yes, we're in the business of helping people to invest in property, but actually far more than that, we're in the business of actually trying to find what is the truth. As a result, we've been able to get significantly better results. Charlie, you talked about getting advantageous outcomes. Just as a little footnote to that, we did an analysis of all of the suburbs that we'd bought in from, but before December 2021, and then looked at the measurement period from March 2020, so start of COVID, to July 2022. And in every area, we outperformed the benchmark by at least 50% in terms of growth, right? So the stuff that I talk about today is not theory, and is not it is not kind of made up stuff, and it's actually not even to drive an agenda. It is to drive a point that people need to understand how to think a little bit differently in order to get outsized returns. Now, whenever a situation comes up, I don't have a predisposed inclination of what the opportunity should be. I mean, if we go back to the start of COVID, yeah, we'd been buying houses for people, but I actually stopped and I said, well, I mean, now what? What if what we're doing is incorrect? And in all cases, I found the right answer is always to be found in actually looking at the data and the facts. And obviously this show is for business owners who want to build wealth outside of business and become a full stack business owner and all of that kind of stuff. And I think that this characteristic is actually something that most entrepreneurs have, and that is challenging the consensus thinking and looking at where the opportunities really lie. And one of my favorite quotes is by Mark Twain. He said, when you find yourself standing on the side of the majority, it's time to pause and reflect. And I think that's probably a good setup for today's episode.
Isn't it? What a great quote we have there. And I think many business owners will relate. I'll say for myself, and I suspect for you as well, Grant, is when I said I wanted to start an internet business, people looked at me like I was crazy.
when I wanted to move to the Philippines, they're like, what are you doing?
Like, isn't that interesting? So like many business owners, I think that if you wanted to go into like a lot of established markets, it would actually be quite hard. Like it would be very, very difficult in that way. So what I would love to do today is, in recent times, we've had some back and forth on Slack. I've listened to a few of your podcasts and I've had more of those moments where it's like my head goes like this. I find myself like tilting. So I thought we'd pick a few areas where there is some, I'll call consensus thinking. And then I would love your thoughts and commentary, and we can riff on that, how things might be a little bit different. So the overwhelming one in the media, in the world going on right now is that if interest rates go up, property prices must go down, Goose. How do you feel about that?
The most succinct version to answer that is factually incorrect. And what we can talk about is some specific data analysis that we did, or we can also talk about some specific empirical observations from historical precedents that disprove that fact. Where would you like to start?
All of it.
All of it. Okay, great.
Does everyone see why he says something like that, Goose, and then like instantly I'm like, all right.
Let me take you guys on a journey, because I think this is going to be really, really insightful for you. And if it's insightful for you, it's probably going to be insightful for everybody else, right? So the general thinking is that as interest rates go up, property prices go down. That is the belief, right? Correct. Now, inversely, then as interest rates go down, property prices should go up. So interest rates go up, prices go down. Interest rates go down, prices go up. So if we just go back to sort of like, the late 80s, what we can find is a really great example there where interest rates rose from 14% to 17%, and at the same time, house prices rose by 35%. Okay, so interest rates not only were crazy high at 14% already, they rose by 3%, and house prices over the same period went up by 35%. Like, hang on a second, that doesn't make a lot of sense. Then, just to as a counterpoint to that, as a counterpunch to that, between 1990 and 1993, interest rates dropped from 17% to 9%. That's an 8% drop in interest rates in 3 years. So, off that basis, you would expect prices to go up, right? Property prices did nothing. They were stagnant. They were basically flat. They didn't do anything. Okay, so that is a huge drop. That's 8% drop in interest rates in 3 years, and house prices didn't do a single thing. Over the period of 2001 to 2007, interest rates rose for about 6 years straight and rose by about 3.5%. And prices over the same period of time, this is national aggregate average price, rose by about 60% over the same period of time. So instantly you can, and I've got many more examples like that. We could probably spend an hour just looking at all of those kind of examples. And so that then starts to beg the question. It's like, well, actually, is there even, in fact, a correlation between these two ideas? Now, I don't actually know where the thesis came from, or you can kind of like deduce that, okay, well, I guess if the cost of borrowing is lower, then more people will buy houses, etc. But actually, the property market is driven by a very broad basket of things that are not interest rates, that are just not interest rates.
I've thought about this a lot. It's like, if I need a place to house my family, like, is interest rates the thing that I'm not going to buy a house because like we'll just go without shelter? Like, that doesn't make any sense. Like, a lot of people, it's like, and it's an essential need. It may change where they buy or what they buy, but them needing shelter doesn't change.
Exactly right. So we took this a little step further, because that's what I would call empirical observation. So that is like looking at a bunch of stuff and going, oh, hang on a second, those things don't stack up, right? So we took it a little step further, and we got our data science team to have a look at it. I posed the question. I said, guys, can we actually take a look at this? And can we actually identify, is there or what is the correlation coefficient between a change in interest rates and a change in median sales price growth, right? So to put that in, want to make sure we don't get too nerdy on this, right? But basically, to put that in very simple terms, we looked at the data and we said, is there a direct relationship between these two things, right? So change in interest rates and a change in median sales price growth. Now, for a little bit of context on this, a very strong correlation would be 90 to 100% correlation. A moderate correlation would be 50 to 70% correlation. And a very negligible correlation would be 0% to 30%. Okay? So that's what you need to know, right? specifically the 0% to 30% piece, because we broke the country up into what's called GCC regions. So that's basically, if you imagine like Greater Sydney, rest of New South Wales, Greater Melbourne, rest of Victoria. So you sort of have capital cities and regional definitions in every state. And we also looked at it on a national level. So we ended up with all of these different areas so we could see what the impact was in different parts of the country and different, because you got to remember the property market's made up of 15,264 towns and suburbs, right? So it's not exactly one market. You can't buy an index fund of the Australian property market. So we had to look at it, and we had to look at it on an immediate basis. So if there was a change in interest rates, was there an immediate impact? We also looked at it on a 6-month, 12-month, 18-month, and 24-month kind of time lag, so we could see was there any delay between those things. So it's a pretty comprehensive study. And we also went back 20 or 30, I think over 20 years worth of data to reference all of this. And we looked at all of the statistically significant suburbs across the entire country. So it's a very comprehensive look at it. The stronger, so I would say, in fact, what's really interesting is that on average, the correlation was actually less than 20% on average across the regions, which is wild, which basically means that it is not statistically correlated, or very negligible correlation is actually a correct way of putting it. The maximum correlation that we found, the zenith, the strongest correlation that we could get in any location was in Sydney and in Canberra, 2 locations specifically, or ACT and Greater Sydney specifically, at the 18-month mark. And even that, the strongest correlation was 30% correlation. Now, going back to what I said a second ago, 30% is negligible, right? So you can specifically say there is a correlation, because there is. You can see that the data moves. However, it is 30% or less, and in fact, in many parts of the country, it's less than 20% or even less than 10% correlation across any of the time series. So to put that in very simple language, because I know we've kind of deviated off into some kind of like heavy topic there for a bit of a podcast, right? To put that into context and to put it simply, at best, there is a 30% chance that there is a relationship between interest rates and median sales price growth in Sydney at 18 months. In most other cases, there is less than a 20% chance that a change in interest rates would have any impact on median sales price growth across the country. Now, I don't know about you, but they're not odds that I would be using to make a good investment decision. Would you?
But you look at that, right? And then I'm going to play the I don't know card on this, because I listen to the news and I watch the data that they're presenting, which I don't believe that they are lying about data. And there is a whole narrative with data to support it that, hey, there are house prices dropping in, and they say nationally, and they say Melbourne, and they say Sydney, and all those kind of things. And the causation and correlation that I see is, well, interest rates have gone up significantly. And so my question is, like, what's happening today from everything that you've just talked about?
I love that.
What's happening today?
I love that for a couple of reasons, right? Because part of where the common narrative goes wrong is they take an aggregate view of the Australian property market. The problem with that is that is not an accurate weighting of the different markets. So if you think about the Australian property market, kind of like the ASX 200 or the ASX 15,264 to be more kind of a little bit more specific, right? So Greater Sydney is like BHP. Right, so the market cap of Greater Sydney and Greater Melbourne and Greater Canberra, right? That like the dollar value of all of the combined assets in those areas is so big that if they change, they have an asymmetrical impact on the rest of the aggregate value of the property market. So I've been using this example quite a lot recently, and it actually just happened the other day in real life, which is really funny because BHP is the largest company on the ASX by a significant shot. If it goes down by 10%, and if you imagine all other companies didn't actually change, but then you look on aggregate at the ASX 200, the ASX 200 would drop, right? So this is actually what is happening. So if you look at the national median house price on aggregate, yeah, of course, yeah. The national median house price is dropping on aggregate, right? But that doesn't mean that is happening everywhere in the same way, right? And then this is actually the interesting point. Now, a lot of people right now, so consumer sentiment right now is at pretty similar levels to when COVID hit, and pretty similar levels to when the GFC hit. So why don't we take a little look at the GFC? Because this is really interesting, right? Because in the GFC, everyone thought the world was going to end, right? And also, property prices tanked, right? So the national aggregate median average dropped by 8.5% to 9%. We'll call it 9% for the point of the discussion.
I was just too young to take advantage of it. I didn't
know,
realize what was going on in the world at this point. I was more interested in my tan and where I was going to go on the weekend than the property market at this point in my life.
Yeah, fair enough. Well, we've actually got one person on our team who actually started investing during the GFC, but that's a whole other story. Anyway, that's a whole other story. So, but let's take a look at the GFC, because on aggregate, the property market tanked, right? During the GFC, it tanked by about 9%, which is massive for like a multi-trillion-dollar asset class. That is huge, right? The value of residential real estate in Australia is like it's like 2.6 times the total value of all businesses in Australia. It's massive, right? So for that to tank by 9% is phenomenal. Here's the rub, right? During that period of time, 63% of suburbs actually grew in value. 63% of suburbs grew in value. So we did a study and we looked at the period of time from January 2008 to July 2009. So we tried to capture the whole kind of moment that all of that stuff was going on, right? Property prices dropped at the same time that interest rates dropped, by the way. Interest rates dropped by, I can't remember, 3, 4, 5. It was a lot, right? So interest rates dropped because everyone was freaking out. They had to stimulate the economy. House prices dropped, and that was all consumer sentiment based. So we then looked at it and we said, okay, well, what actually happened on a more granular level? So we found that, as I said, 63% of suburbs still went up in value. Of the suburbs that went up in value, the average growth over that period, which is like 18 months, was 9.04% average growth across the suburbs that went up. And also the average price of that was 382,763. So that was in the lower quartile. So that was like more affordable properties.
Yep.
On the other end, the negative growth suburbs on average went down by 7%. On aggregate, and the average price of those was actually well over $500,000. So they were the more expensive suburbs. So what we can deduce from that is really interesting. So not only can the market go down, but in fact the majority of the market still go up. But in fact, more affordable properties tend to perform better when consumer sentiment is lower. Now I'm sure you got questions about this, but just
totally.
Let me hang on this for a second.
I love it when we get Goose on a good roll here. Like I'm almost like, we're just going to be quiet here and let him go. There's so much wisdom in this. There really is. And like, I'll bring this back to business owners quickly here though. I find it very interesting that depending on which room you go into, they'll tell you right now that the business environment is terrible or amazing.
Totally.
It depends on the room.
Yeah.
So right now I feel like I'm living in the upside down. When I talk to certain business owners, they're like, oh, wouldn't want to hire someone right now. Well, wouldn't want to take any risk or open a new factory, open a new location because like we these rates, everything going on. Conversely, is like we've hired 4 people in the last month. I will actually say this: I've never had more people reaching out to me to work with us or wanting things from us. And I look at it and I go, it just doesn't agree with the consensus. Like you can create your own recession, you can create your own downturn if you're just tuning into the consensus, because these, and I think it aligns really well here. If you follow the aggregate, the index, business environment's terrible. I could literally come up with 10 reasons right now why we should do nothing in business. We should just bunker down. But if you dig a little bit deeper, like our media company's booming. Like we're seeing opportunities every day. I'm almost more challenged by, can I get the funding, people, utilities, and training in place to grow? Because now is the time. Then this environment is not right.
Bingo, right? Because there's two philosophies when the media narrative, which is another way of saying the general sentiment of the population, turns sour. There's only really two ways you can approach business, and real estate investing is business as well. So it's all basketed to the same way. You can conserve and contract, cut costs, trim fat, reduce, sacks of people, try and conserve as much cash as possible, wait it out.
I've tried to sack Grant several times.
Yeah, I was going to say,
HR claims on me.
I haven't had payroll for like 6 months. Like I'm just like, I just can't take hints.
He called unfair work dismissal on me. I couldn't believe it. I get this phone call asking.
It's funny. But you can conserve and contract, or you can grow, right? And so to your point, Charlie, about the business environment, look, the stuff that I'm talking about, this is not like me trying to I think we're hiring 15 people at the moment. It is all guns blazing, because the reality is different from the story. And this is the point, right? So to illustrate that, and so just to anchor back, so during the GFC, when on aggregate the market went down by 9%, 63% of suburbs actually grew. What? My mind was blown when we discovered that. We looked at the last 6 months, right? Because the current narrative is that the property market is crashing. The property market is crashing. It's all going down. It's all bad news. And so literally we just approached it with a very open question. How many suburbs in Australia have had positive growth over the last 1 month, 3 month, and 6 month period, right? Very simple question, not loaded. It was just like, well, let's just look and see what the data says. So what I can tell you is that over the last month, 58.79% of suburbs have had positive growth. Over the last 3 months, 76.7% of suburbs have had positive growth. And over the last 6 months, 88.86% of suburbs have had positive growth. Now, what is also interesting as a footnote to that is that 53.16% of the suburbs nationwide grew consecutively through every single one of those periods, right? Because what you may find is a suburb went up and went down and went up, and they do fluctuate, they vary, right? But on aggregate, over the last 6 months, 88% of suburbs have gone up in value, and over 50% of suburbs have grown consistently across every one of those time periods. That in and of itself tells you that something about the consensus story is factually incorrect. Now, I have a theory around why this is the case, right? Because
that was my question.
Can I guess?
That was my question. Yeah.
The politicians are buying. That's what I can come up with.
Well, look, if you want my sort of slightly conspiracy theory version of it, it's
yes, I do. Definitely.
Okay.
Definitely
All right. The slightly conspiracy theory version of it, and I say this with a chuckle, right, is that maybe the government is telling the media to tell everyone it's a bad news story, so they all freak out and stop spending money to try and lower inflation, right?
That's not a conspiracy. I feel that's way too legit.
I'm just mindful of not coming across tin hatty, right? I like to, yeah.
All right, so they're putting this media cycle out so that they can, because we know Melbourne is affected, so they can drive down the price of property specifically between where the new train line is going to be between the airport and Melbourne. They're scaring everyone. They're loading up on the land in, and then they're going to put the infrastructure in, and they're all going to make bank and sell. Now, that's a conspiracy theory. The conspiracy of why Melbourne Airport doesn't have a train line and the land potential around this. Now, that I can believe. Your one was too straightforward, Goose.
And then the same for the Greater Western Airport for Sydney or something like that.
I'll let the listeners decide on that. I'll stick to the facts. Because but I do have a theory around this, and it's really about approach. Because Grant, you mentioned something just earlier. It's like, well, there is data that says this, and you can correlation is not causation, right? So that's one thing, right, that we've got to really be really clear on. We actually also can't find causation between interest rates and property prices, not just correlation. And so if you look at a graph over the last 30 years, and you look at a graph that has interest rates on interest rates and property prices, median property price, you'll find that across the last 30 years, interest rates go down, and across the last 30 years, property prices go up. So you can go, oh, look, one goes down and the other one goes up. One of them has a compounding factor into it, right, which is property prices, and the other one is an arbitrarily set value by the RBA in response to other macroeconomic factors. So they're not actually specifically related. Now, when you get a news bite which says, look, the market is going down, and also, look, interest rates are going up, it's very easy to say those two things are related, when in actuality, they just might not be, right? They just may not be. And the people who are bringing those narratives forward. Some of them I respect, right? But they're actually talking in an area where they don't have any expertise, and they're viewing it as something like a financial market. Whereas the real estate market is not a financial market. You can buy an index of the ASX 200. You cannot buy an index of Australian property, right? So to take that assessment of how you should measure the success or not of a market is kind of incorrect. And so there's kind of this like economist financial market view, which doesn't directly relate. The real estate market is it's the highest valued, least understood asset class in the entire world, right? So you can't necessarily superimpose the same methodologies to get to the same outcomes. So I don't think it's necessarily maliciousness. I actually think it's potentially a bit of ignorance in the approach, which is fine because you don't know what you don't know, right?
So
completely.
I'm going to put this out there because I'm thoroughly curious. Sorry, Charlie. This episode, I'm going to jump in.
Go for it. It's your time.
So Goose, I love that concept. From your analysis as to whether it was in GFC 2008 or right now, it is a point that property prices have dropped, and I get your BHP example. My question is, looking at it now, why do you think that property prices have dropped if it is not caused by interest rates? Like, what is that?
It's a really good question. So I think that part of it is a natural part of the market cycle for Sydney. Now, if you go back and listen to anything I've said on a podcast for probably the last 2 or so years, even when Sydney was going up, I was saying, guys, the right time to buy in Sydney is probably going to be in about 5 years' time, right? That's simple. It's not now. And so I think it's actually a natural part of the cycle for Sydney. I think that Sydney had a bit of irrational exuberance, and it was not. There was no functional reason that should have been the case. And in fact, you could tell by the sales volume data, 12 months prior to any kind of price movement, you could tell by the sales volume data in broader Sydney that the market was going to go down. So the trend of the influencing factors of the Sydney market going down started at least 12 months prior to any kind of change in interest rates. So the thing about property markets is that they are very complex, and there are multiple drivers that cause markets to move in different ways. And in fact, the different drivers apply to different locations in different ways. And that's what makes it so truly fascinating, because the things that make Sydney expand or contract don't necessarily make Wagga Wagga expand or contract, right? They're quite different markets. So part of it is focus, right? So part of it is focus, right? So as I mentioned earlier, it's like, well, yeah, cool. So I think we could all agree that on aggregate, Greater Sydney prices are going down, but also you probably find that some places prices are going up in Sydney as well, right? There are some people who are still smashing and getting above their listing price, So it's not all, it's a very granular affair. But on aggregate, you can argue that Sydney has gone down. Why? There was a lot of irrational exuberance, so maybe it's a reversion to the mean, to a certain degree, a settling of the market. Why? Because it's part of the cycle. It's had a very good run for a pretty significant period of time. Why? Because in actuality, the purchasing power of individuals is corroded when interest rates goes up. So this is why more expensive markets. So there's two tranches in more expensive markets. There's the ultra expensive markets where people don't get mortgages anyway. So typically 10 million plus, where they're just buying in cash anyway. $30 million house is bought in cash, right? So things like cost of capital don't really matter that much. But in the kind of 1 million to 10 million kind of range, thereabouts, it matters a hell of a lot. And so access for people to be able to get into properties changes when interest rates goes up, because their ability to actually get a loan changes because the buffer rate goes up, so they might not actually be able to get the finance. That reduces the buyer pool. You've got people who so you start to then look at this like can people buy in that market, and is it desirable with that volume of debt? So in times when consumer sentiment is good, now note that I'm referencing consumer sentiment, not economy, because the underlying economy is actually pretty bloody good, right? But when consumer sentiment is good, people perform aspirationally. So they'll try and upgrade their house, they'll buy a boat, they'll get a nice car, they'll do the thing, they'll do all the stuff. And then when consumer sentiment is low, they'll tend to defer to more cost advantageous or value-based decisions, right? So what we tend to see when consumer sentiment is lower, there is a trend towards more affordable. Now, I'm not saying cheap houses. I'm not saying everyone's going and living in $300,000 houses, but you have a trend towards affordability. And so then again, because markets are a complex affair, you can see that on a let's say Greater Sydney, you can actually see that the areas that are more affordable will still be performing better than the areas that are less affordable, because there'll be a trend towards that direction whilst people want to stay in the vicinity of their ability to service the utility of work, keep their kids in the right school, etc. So I think there are elements of it from a natural affordability perspective. You've got to remember we've got inflation as well. And I think there are multiple factors in there. But it's not a specific factor that it's as simple as like a lever that you pull where interest rates go up and prices go down, because it's not happening everywhere. But there are some impacts in different markets. And we can actually see that through the correlation analysis. So just to kind of remind you, the strongest correlations that we saw were in the more expensive markets. Sydney so Greater Sydney, ACT, and Melbourne were significantly the highest correlations. Why? Because they're more expensive, right? And so cost of capital matters a lot more when you're leveraging yourself up and taking on more debt. Because incomes haven't changed as much as property prices over time. So property prices have outpaced income growth. So then in that sense, the more expensive markets have significantly, in an asymmetrical way, outstripped income growth, but more affordable areas haven't necessarily done the same. And so you can kind of get this balancing effect, which is honestly why regional areas are performing so well, because you've got the disaggregation of workplaces where people can actually work from wherever they want, so they can choose to have the lifestyle they want and all of these kind of things. So societally, there's a big shift as well, which is obviously changing the game too. So
I'll tell you what, I would love to get a hold of like the supermarket data and see how many people have shifted to like buying like bulk items or more affordable solutions with the sentiment chart. I think it'd be a really fascinating thing. But Goose, it seems you've shot down in flames our first point of why the general consensus of interest rates go up, prices go down. I think we can basically what was that show? Was it Mythbusters?
Yeah, Mythbusters.
I feel like we've just had a Mythbuster. I like it from there. And I will also put in the point, Goose has a complete data science team and pays to get access to a huge amount of data. This isn't him winging it off what he gets on a monthly report or his views. Like, he's got source of truth data here. I just want to make it really clear on that.
Yeah, I'll just add to that. So we've got 6 PhD data scientists. We're we're spending this year alone. We're going to spend probably close to 2.5 million just on improving our analysis, which is a huge amount of investment in R&D, right? And we've got 17 people in that whole side of the business. It's a big team. I'm not doing this analysis. I'm not sitting there going, There's like PhD data scientists and stuff that are coming up with this and giving me the outcomes. I'm just expressing these facts.
I'll tell you what, though, it does make you look great.
I was going to say you look smart. All right, everyone. The episode with Goose actually ran extremely long, extremely long, and it was so powerful. It was actually probably one of the longest episodes, Charlie, I think we've ever recorded. So be sure to be tuned in for part number 2. Because these myths keep getting debunked. So for everybody, if you want to continue the conversation, head over to the Facebook group, which is called Full Stack Business Owner Community. Continue the conversation. Anticipate, what do you think the next myths are? And be sure to tune in on part number 2. So I just want to say thank you very much for joining us, and we look forward to catching you on part number 2.